didn't get lost in the woods. You didn't cancel me yet, Anthony Smith.
I think this episode might be the episode.
This is it. All right, this is the one. This is the one. We got a big show today. Really big show. This is going to be an hour long, but I'm going to try to break it up into pieces. We're going to try to break down some of this economic environment that we're in right now because it's quite complicated.
I don't think it is.
Okay, maybe not. Maybe Anthony's going to make it simpler for you, but I tend to think it's actually quite complex. So Zach Strickland here, head of Freight Market Intelligence, Anthony Smith, chief economist. This is Freightonomics, the show where we break down the freight market and the macroeconomic environment, mush them into one big ball, and hopefully make it easier for you to go about your day and your business.
Exactly. And if I'm looking down, that's because I'm only being a little bit rude. I'm going to be checking LinkedIn. So as Zach mentioned, this is a jam-packed show. We're going to be here for an hour. So get your popcorn, get your water, stay hydrated. We're in on this discussion. If you happen to be watching live at 12 Eastern Standard Time on this Thursday afternoon, be sure to go on to our LinkedIn as well because you can join in on the live conversation. If you want to rewatch this later on, you can go to tv.freightwaves.com, of course. But right now, you're live. Tune in and join in on the conversation.
Yeah, so today we've got a lot of topics to cover. So especially for those of you that are streaming or watching this maybe on YouTube later, you may want to jump down to some segments to get a little bit further breakdown. We're going to start off things, of course, with the market in two, which I will go through in a minute, which will give you just a high-level freight market update. We've got a timer for it today.
Oh,
yeah,
fancy.
The team put together some timer for me, so we'll do that. And then we're going to break down inflation, the jobs market, the things that are contributing to inflation that may not be something that you overtly can see. I mean, we hear about the Fed's rate. We talked about that a little bit and how that interconnects with inflation, how that may not have been, it may not be the right move in this environment. We're going to talk about the supply chain and what has happened through this past 2-year period that is contributing to inflation. Some of it actually started before the pandemic and was just exacerbated by it. So we're going to break all that down. And hopefully they'll make some sense of the noise that is the U.S. economy right now. I'll show you actually the global economy.
And there's a lot of noise to kind of cut through as well. So, Zach, are you starting it off with your market in two?
Let's start it off with the market in two. So the market in two, we started doing this. We didn't do it last week because I wasn't here. I was in the woods. But what this is going to be a quick high-level overview of the freight market environment as we see it with our sonar data. I go through a few charts, a few data points to explain what we're seeing in the near and long-term context. So without further ado, Anthony Smith, let's get that clock up there and let me know when to. All right, let's start it off. So first chart we're looking at right here, the OTVI, Outbound Tender Volume Index. The Outbound Tender Volume Index, of course, a measure of aggregate demand for trucking volumes. This is the measure of shipments that shippers are sending to carriers. The higher this goes, the more demand there is. The lower it goes, less demand. Less demand puts downward pressure on spot rates. High demand puts upward pressure on spot rates, and then contract rates if it stays up high enough. The green line you're looking at is last year. The white line is this current year. The blue line is 2 years ago when the pandemic was getting going. If you notice, this thing is going down about 3% since June. So we are in a slow downward demand cycle. So the next chart I want to throw up here is going to be our Outbound Tender Rejection Index, OTRI. OTRI, now this is the percentage of that Outbound Tender Volume Index that you're looking at that has been rejected by carriers on the other end. So these are contracted carriers that are saying, yes, we will take your freight, or no, we will not. The more often they say no, the higher rates will go because shippers will inherently bid their prices higher to get this compliance. Right now, we have dropped below 6% for the first time since 2020, indicating that we are still seeing carriers take on more and more of this contracted freight. The last chart that I want to show you to bring this all into connection is the spot versus contract. Green line is the contract rate. The white line is our NTI with a base fuel cost level of $1.20 per gallon. The big takeaway here is that the contract rates are still very sticky. That green line is not moving downward, but it has come down about 2% since the end of June. And then, of course, the spot market, not really moving. The big question here is, are shippers actually pulling out of the contract market a little bit to go into the spot market to get a discount, because that discount continues to be extremely heavy?
Impressive.
Bam.
On the dot. On the dot, Zach. That was good because you really it was a true market overview here.
Yep.
Out of all those charts, what's going to be one of the most surprising ones for you?
I think the big shocker for me is just how flat all of them over the last 2 months have been. They really haven't changed a lot. I mean, you look at some of these charts, and in March, in April, all of them had this huge just jumping off a cliff aspect. And since then, we've really been kind of just hovering. It's almost like we're adjusting to this new level. Like to me, it's unprecedented to see such a quick adjustment.
Right.
It's like an L.
Yeah.
An L-shaped movement in the freight market. Now, what concerns me is that spread, that last chart that we were looking at, that spot versus contract. That is inflation in action. And this is actually a microcosm of a deeper discussion that we're going to get into here a little bit later, is, with all these, demand side adjustment factors that we've seen, the interest rate increases are, of course, there to kind of inoculate us against too much demand. Well, something we haven't really taken into account is the fact that, demand has actually already come down in a lot of sectors, but the inflation has stayed in place for now.
Right.
But like I said, with that contract rate, it's starting to show signs of coming back because that spread, the difference between the contract and the spot market for truckload, it's not sustainable and it will not last. So
the contract's going to be coming down. And is that going to be around bid cycles? And
one will come up or the other will come down. It cannot exist in that state for long periods of time. So if you do the math on it, you're going to see, and say the spot market stays exactly where it is, the rates stay exactly where they are, we're going to see an 18% retraction in that contract rate.
Interesting.
Now, it doesn't suggest the timing of that. I think we're going to see at least a 3 to 5% contraction here in the fall initially. But I think longer term, we're going to head towards that 18% number.
Interesting. Yeah. So Zach, I think that you're spot on. Usually, I know this show kicked off originally, over a year ago, over 2 years ago now. Goodness, of us really just having contracting outlooks and views on certain things. But as of late, we've really been kind of honing in on a lot of the same trends. And the one that's really been interesting as of late is going to be around the jobs market. I think.
We need to break down the jobs market. So this is the thing that everybody even outside of the economists have been really citing. So anytime you hear the Fed talk about the jobs market as like it's still strong, so that we're going to increase rates.
Yeah.
And that may not be like I don't personally, and I'm going to lean on you here. Increasing interest rates being obviously the one publicly, the public thing that the Fed can do, to kind of say, hey, we're doing something. I don't see it really actually solving the inherent situation here. Jobs market being so tight, labor market being so tight, we're seeing a trend where it's changing, right?
Yeah, and that's going to be one of those areas when we're looking at the Fed that we kind of talked to a few episodes ago. Kind of got to take it like an earnings call. They're going to say some things and really kind of paint it as bright as possible, even if things are looking grim. And so the Fed might know, and they likely do know, that the job market isn't all what it's cracked up to be. And we're going to dive into some of those trends right now. But they're going to have to use that as the holding point to say, hey, this is going to be evidence that we can increase not inflation.
There you go, a little Freudian slip.
Increase interest rates as we continue to move throughout 2022, because they know they're going to need to use some of those tools, quantitative easing and lower interest rates, things like that, in the latter half of this whole recession. So that's going to be one of those areas that we look at. But we look at the job openings. This is going to be one that's is lagged for sure. So this is a lagged indicator, but that's fine. It's not going to be forward-looking, but this is going to be something that we have to look to tie everything together. And so we're looking at job openings. The latest numbers show that there was a downward movement to 10.7 million job openings in the U.S. This is slowly but surely moving down, trending downwards. And this was definitely in bubble territory because we saw that there were almost double, or there is double the job openings than there is available labor. So this is going to continue to trend down likely. Might not be smooth, might be a complete fall off. I think it's going to continue to trend down steadily until through November at least. And so That's going to be one to watch closely.
But it's accelerating, right? I mean, we're
downward movement?
seeing the downward
Yeah.
movement really accelerate. Does that not concern you?
No, because this is going to be one of those areas that. So I think there's an order of operations of this, and
Okay.
and this is something that I've really been expecting for a while, because I remember in the early parts of 2022 we were saying the jobs market is the last stronghold for the U.S.
Yeah.
economy. So when we look at the job openings come down, that's going to be the first thing. We're also going to start to see weekly initial jobs claims come up, which we're seeing right now. A lot of people are saying. I saw a headline today, something like initial jobs claims are a cool breeze over a hot job market, or something like that. So we're going to start to see those come up. Initial jobs claims. Those are going to be released weekly. It's going to be a little bit more timely, higher frequency data set for the jobs market. But we're going to start to see that come up, and we already are. And so the other big thing that a lot of people are going to be focusing in on is the unemployment rate. We saw that down to 3.5% in the latest report, matching the pre-pandemic low that we haven't seen since quite a few decades.
Look at that! Look at that chart.
And it's down there. And
I mean,
if I were looking at nothing else, I would understand why a lot of folks are going to be looking strictly at the unemployment rate, saying that, hey, it's a strong economy. But when you dive deeper into some of those unemployment trends, you're seeing that the payrolls, which is essentially the number of people added to the workforce over the last month here for that report, we saw that there were 528,000 payrolls added. So that means there were 528 new jobs had, although we saw the participation rate go down 0.1%. So that's showing that there are more jobs being worked by fewer people than what we had at the beginning of the pandemic. So that can show, or kind of start to suggest, that there are more people working part-time jobs, especially when we saw part-time job labor for economic reasons in the latest JOLTS report, showing that there was over 300,000 part-time jobs added in the latest month. So this is showing that a lot of folks getting hit by inflationary pressures are taking on second jobs, taking on part-time jobs potentially, in order to combat some of these inflationary pressures that they're hitting. The wages aren't growing as fast as inflation, and this is going to be one of those areas to watch closely. Of course, we got the CPI, PPI numbers that came out this week. A lot of people are saying, all right, it's over here, and if we were to look at, so I had a quote, because we put together a daily watch weekly outlook every Sunday. It goes out.
Sonar subscribers get it every day.
Sonar subscribers. And if you want to get in on it, subscribe to Sonar. Easy as that. But we have a quote here. And one of the things I outlined in this is that there might be some easing in inflationary pressures. And I put there temporarily. Because I did expect some downward movement here in this month. And I think might be some cooling, a little bit more in inflation. But that does not mean that there's going to be some ongoing downward movement continuously throughout the remainder of 2022 into 2023. There's going to be some sticking points here. And the downward movement that we saw in this latest report, a lot of it came from gas prices. And
the energy sector. I think it was pretty much all in the energy sector, correct? And food, everything else went up. But the energy sector, of course, obviously operating at an extremely high level of inflation, has been driving a lot of the inflation over the last several months. Came down. So instead of that 9% number that they were targeting, it was 8.5, I believe. Is that right?
And so that's going to be one of those areas that we have to watch closely, because it's going to be telling of how sticky some of these inflationary pressures are. And I know we're kind of going into the next part of it a little bit more, where some of the sources of this inflationary pressures kind of came from and where they're shifting to now.
And we're gonna break that down in a bit. But I do like everybody watching needs to understand there is noise in these aggregate macro figures. That 3.5% number that you saw in the unemployment rate does not mean the same thing as the 3.5% that we saw pre-pandemic.
The composition is completely different. So the participation rate, much lower than we saw in the pre-pandemic level. This is kind of like when I was in high school, I weighed 225 pounds. And that was pretty big for a high schooler playing football, whatever. Not huge, but that was pretty decent. After high school, after college, I got a lot stronger, but I was still 225 at one point in time. But my composition was different. I had more muscle mass. And so right now what we're seeing in the job market, and right now I have a lot less muscle mass years later, but right now what we're seeing in the job market, there's less muscle mass in that composition. There isn't as many workers in the workforce right now. So that 3.5%, like you said, right now doesn't sit the same as it does before the pandemic.
And a lot of the workforce, you have the underemployed that are counted in that number, those part-timers that might be looking for full-time. You have people that, just worked a random job,
Yeah.
for a week, and they get counted as employed in that situation. So there's a lot more context that you need to have. You can't just look at these aggregate figures and take them at face value at this
Exactly
point,
right.
which is a few things that we're going to break down. So jobs market, you can't just, I think the big takeaway from that section is the jobs market isn't quite as strong as people still think it is. Now, it's very strong, historically speaking, and there's still plenty of people with jobs, but the trends are, of course, moving towards less employment, correct?
Correct. And if you look at the beginning of most recessions, they started off with decent unemployment rates. It hit peak unemployment rates towards the end of the recession. So it doesn't mean that we started to kick off a recession with, record high levels of unemployment.
Now, there is some political stuff going on in the background here that might have something to do with it. Of course, immigration before the pandemic, and this didn't get a lot of press, but we kind of cracked down on immigration in a way, and that has actually removed several workers from the space. Do you have any context to add on this one in the way that it might be manifesting itself a little bit more prevalently now, since the economy has kind of come back out of that pandemic era?
For sure. And so, when we look at the US, the cost of living is much higher here. So pay is usually higher here. So there's a lot of elevated job opportunities here, even for those job opportunities that a lot of Americans don't want.
Right.
And a lot of them being in the service side, a lot of them being in some labor heavy intensive areas. And so a lot of the times, even though a lot of Americans didn't want these jobs because they weren't paying as high as some of the other ones were, people might immigrate from other countries, say, hey, I'll take this, I'll grind it out, and I'll move up, 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 and up, or I'll continue to save up cash here. Because there has been that crackdown on some of this immigration, we're seeing that a lot of those jobs that would have been worked by a lot of folks coming over to the US to help out and work in the economy is just being slashed up, like you mentioned earlier. And so that's going to be another area that's going to hurt us, and really going to hurt us in the long run, not just for entry or service sector jobs, but higher level paying jobs as well, especially looking at executive roles as well, because you see a lot of countries as well that might have, especially Europe, India as well, very highly trained individuals that might immigrate here to take some of those tech jobs, things like that. So because of those difficulties, that's going to make it harder to fill some of those roles. And that's going to be one of those areas that we're seeing a little bit of inflation at. Some of those entry-level jobs that there's really going to be some of those roles that a lot of people don't want, but a lot of people took over this last month or so, because we saw a lot in hospitality services that were added in this latest jobs report and for the payrolls number. But that's going to be another area to watch closely, because those are shifting demographics for sure.
Yeah, the services sector, of course, largely taken out of the picture during the pandemic, has now come back. And I think we're starting to see some of these earlier policy implementations show up a little bit more heavily. So what I want to do now is I want to start telling the story of the pandemic and how we got here from a perspective of our data. This is something that I kind of put together for, basic presentation purposes. And I want to break down how we got where we are a little bit, because that requires a little bit more of a recap of the pandemic era, some of these policies, and now what we can take away moving forward, how we need to kind of view our new economic environment per se. Because to understand the present, we have to look a little bit back at the past and how we got here. So the first thing I want to bring up is consumer demand. And this is going to be a chart of our outbound tender volume index with a lot of little call outs on it, and overlaid on the portion of the PCE, so personal consumption expenditures, which will be in the blue line there. So if you look at the white line, and I want you to focus on that one for now, because if you look at the white line, that's tender volumes. That's what was in the Market in 2 update. That's shippers requesting truckload capacity from their carriers. It dipped and then it spiked after that initial little wave of toilet paper purchases that you see there in March. It has a little call out on it. And then it dipped all the way down to one of its lowest non-holiday levels ever, about 8,300. And then from there, it shot all the way up to about 16K, where it has been hovering until just recent months or earlier in this year. So that record level of demand showed up in front of that PCE, which of course is a little bit lagging because it's reported monthly and it's after the fact and it's reported in dollars, so it's not a one-to-one equation. So I want you to make sure that we understand that this whole thing started on the demand side.
Yeah.
A lot of the discussion about were we overstimulated? Absolutely. But that's not the entire picture. All this economic stimulus packages, and I have these in those call-outs in that chart. If you want to go back to the chart and freeze this thing, when the stimulus packages came out, you can see at certain levels, especially right there, right after that peak, actually at the trough was the first stimulus package that came out. So people were working from home. So we had also this societal shift, people working from home. They got some money to work from home and not overt in this figure. And in these figures is the unemployment support that we got from the government. So it's not a straight stimulus package. This is something people got for unemployment benefits.
Right.
That's basically ongoing throughout this. So those figures are also in here. So we have this record level of demand that started this process of overwhelming supply chains and production. So I want to pull up the next chart here. So you saw the OTVI, you see that it's going to, we're in this, this cycle of coming back down. This next chart that I want to pull up is the OTVI, the CPI with PCE. So the personal consumption expenditures, as reported by the government there. So in the white line, that's our PCE. That was what was overlaid on top of the OTVI. You notice the PCE did not come down and correlate with the OTVI there at the end.
Right.
Why do you think that is?
Did people stop buying stuff?
No, it's because of inflation.
Oh,
inflation.
They kept buying stuff with inflation.
And that blue line that you see there, Anthony Smith, is your favorite CPI. This is the thing that's getting all the press right now. Consumer Purchasing Index, basically the cost. So what I did here in this chart is I should have done this from a different point in time, but the direction is still the same. I adjusted the PCE to the blue line. So the CPI for May of 2020. So obviously that's down a notch. We actually saw a little bit of deflation there at the very front end of the pandemic. So I adjusted the PCE to that value over time. And you can see that white line with a little call out bar on it at a certain point. But if you look at that white line underneath the other white line, in between the two lines, how many times can I say line? Consumer demand peaked second quarter of last year.
Yeah.
And ever since, it has been on a significant deterioration. Now, a lot of things are going on here. There was a Texas freeze, supply chains froze, carrier networks were shuttered for a week in the second quarter. Or the first quarter, I should say, of 2021, right, which of course led to this. It kind of overstimulated the consumer as well. We had another stimulus package come out in March, right after this Texas freeze situation and this polar vortex, which of course sent shippers and also consumers into a deeper level of panic purchasing because they couldn't get their stuff. Right. So it's the scarcity principle in economics, right? Right. Exactly. If you can't get your stuff, you go out and you overorder, correct?
Yep, and that's one of the big things that we saw, especially throughout the latter half of 2022. A lot of these producers upstream, I think, understandably, they didn't want to get caught in a bad position once again. They didn't want to forego potential gains by not having what they needed on hand. And so what they did was they overordered on a lot of things. They didn't know exactly what they're going to need, but they know they needed stuff. And so they pulled a lot of it forward. So we saw, of course, Christmas shopping start kind of get kicked off throughout October and November. And then we started to see a lot of the goods continue to flow into the country into the early parts of 2022. And that really all kind of came to a head throughout the late second quarter, early third quarter in this year.
Yeah, so what we had initially was this overwhelming demand. And then seeing as these companies and consumers weren't sure if they could get the stuff that they wanted / needed, that then stimulated them into, not just because they had money, but it also motivated them to order more than they potentially needed / wanted at the time, correct?
Yeah, and that's going to be one of those other areas where I kind of overlooked this part, but we also have a chart on it, and that's going to be credit card utilization. A lot of these consumers were able to pay down a lot of their credit cards, a lot of their debt, things like that throughout the pandemic, as you can see by that huge dip through a lot of those stimulus packages. As of late, it is very much elevated in comparison to what we saw throughout the pandemic. We're seeing a lot more consumers having to lean heavily on credit card utilization, and that's going to be to buy basic things like groceries, gas, things like that, just living.
This chart is insane.
Yeah.
So basically, people had more money than they needed
Yeah.
throughout the pandemic. So they saved some, and of course, I'm not going to get into the demographics of savings and all that kind of stuff because that's a whole nother topic in general. But in aggregate, people bought they had money to buy stuff.
Right.
They had the time to buy it, and then they threw a bunch of money down on their credit cards and their debt because they had more left over.
Exactly.
And now, I guess the big question is, Anthony, with that credit card number shooting up like that, and we've already seen it in the PCE when you adjust for inflation, which isn't exactly the most scientific way to do it. I'll admit that, but the direction is the same.
Right.
The consumer is not spending as much money, and they haven't been for a while, and now they don't have as much money as they once had.
Yeah, and that's going to be an issue. And the thing that a lot of folks are going to be pointing to, and rightfully so, is the job market that's really continuing to fuel a lot of the ongoing activity. One of the things that we always I at least always talk to at the beginning of this show many years ago was going to be around consumer confidence. It's important. Consumer sentiment, it's important. And it is, but I leaned away from that because consumers were acting differently, and they were acting differently because they can get a new job, they can trade up in job, or they can get another job and help support their buying and purchasing and consumption, things like that. So that's going to continue to be a thing. But the thing that we're going to start to see at the final phase of the order of operations for this job market is going to be layoffs. We're starting to hear more and more about layoffs. It hasn't spiked up considerably to where I think it's going to be going towards the latter half of 2022 into 2023. But we are starting to see that more consumers can still trade up. But once that's taken away, we're seeing that this record level of credit utilization is climbing up. We also have this black box of that's been growing of buy now, pay later, or pay over time. That's also being a thing. We also saw that delinquencies for mortgages are starting to tick up. So this is all slowly starting to happen under these underlying trends here. And so it starts to get a little bit concerning when you look at the strength of the overall economy. And I think for sure the Fed knows this. And so because they know this, they understand that they're going to need to have something in their toolbox to help bring this all back down. And that's why there's going to be such a push forward to increasing interest rates over this next, I think, few quarters here, or next few months here.
All right. So we've established where we came from.
Yeah.
We know where we are currently. We are in, would you call it a transitionary state economically?
Definitely transitionary state.
Yeah, so we haven't settled on anything. The freight market might have leveled out for now, but the economy is not done transitioning.
Yeah.
Okay, so we're right there. And we're seeing the consumer also be in a transitionary state. Jobs markets are moving. Anytime that you see a line going, a different direction than it was over a period of time, like we just saw with the credit cards data, that is a transitional state.
Right.
And most of the economic processes are there. So this whole thing started with demand. But I think what we're seeing right now in the inflationary process is a supply side situation. And I'm going to explain why. So everything you just talked about, the jobs market, what is that?
That's essentially enabling people to buy stuff.
Right. But if you can't hire people, you're going to have to raise your wages.
Exactly.
Production, supply side. You can't source your means of production fast enough. So that's going to inflate the wages.
Yep.
Which is a process of the supply side. Think about it. Economics 101 is supply and demand curves, and they cross. Right. To me, the jobs market is a supply side situation, which is adding to inflation. So if you don't solve the problem of, having enough people to work, that inflation is going to continue.
Right.
There's nothing the Fed can do in the near term that says, except for obviously further downstream with the demand cycle, capital investment, giving companies money, consumer demand erosion way down the line because they can't afford stuff. Is that not already happening with the labor market?
It's already happening.
It's already happening.
Yeah.
So what we've seen so far with that interest rate increase is really not manifested materially.
Yeah.
We were already starting to see inflationary processes from the supply side start to trickle in. Now, a lot of it resulted from demand, though, right?
Yeah, a lot of it resulted from demand. And I think this is going to be one of those areas, like you said, is transitioning from that demand side to the supply side.
Yeah. So the next portion of this, of why I think the supply side is still is actually the main part of the problem at this point. You saw the PCE. That is a measure of demand. You saw the OTVI. That is also a measure of demand. The PCE may not have come down nominally, but if you adjust for inflation, it's been down for almost a year now, and transitioning down. OTVI came down in March. Demand's already eroding. Everything left, and CPI is still on the rise, has to be coming from somewhere else. And to me, the jobs market is one of it. The second part of that, production. China, where do we get all our stuff? China?
All China, yeah.
It's basically all China, Asia. They have a zero COVID policy in place.
That slowed down a lot of being able to produce a lot of those goods.
Still. So when you can't produce the stuff, what does that do to prices?
That's going to also be an inflationary builder.
So even if your demand has fallen, if the supply side has contracted faster on that curve, which it has, in my point of view, and disagree with me. No, he's not going to. Not today. It's going to keep inflationary pressure going up, even as the demand side comes back down.
Yeah, and I think the other point that we have to make is that replenishment, because that feeds into this right now. We saw quite a bit, of course, with the supply side really being disrupted as we're kind of building out now, but the pull forward for goods that need to be really in position at a particular time of the year. So you're looking at seasonal items, things like maybe it's sporting goods, maybe it's back to school. These things need to be replenished. And this means that, of course, warehouses are going to have to kind of be reshuffled, reorganized, because there's so many other goods that got pulled forward that was increasing inventory levels. And so now that has to get pushed out. We're seeing a lot of course, those fire sales of like, get rid of this, because we need to make room for all these other goods. And so that's going to add into inflationary pressures as we continue to see a lot of those replenishments need to get in place at a timely fashion.
So put that one into context for me, because I'm not really sure how inventory levels fit into the supply-demand curve. Okay. Like put this one into context, because I get the labor and the cost of production and the shortage situation, even as, the cost of production goes up and the consumer side, it takes a minute, to adjust. The inventory being over, like you don't have anywhere to put stuff, or the inventory now costs more. How does that play into the supply-demand?
I think initially inventory goes into the supply side because you have more stuff, it goes into the supply side. But when you start looking at the demand that's not for that supply right there, you're going to have to undercut some of those prices and just take losses on it, take hits on that. So I think it starts off with the supply side because, of course, it's inventory. But I think like the point we're making out here, it starts to shift to demand because this isn't the demand that a lot of people want. This is an oversupply of goods that got pulled forward. Now we start to see the goods that people are going to want because of seasonal items, that's going to shift everything else. And so I think that goes back into the supply side and inflationary pressures.
But I think you just made a point here that I like. So not that that's terribly shocking, but so that inventory that everybody has, you just said that's inventory people don't want. So now this inventory, which would have sold a year ago at a higher level of price, is now going to be sold for a lower value. So we've actually eroded economic value from that perspective, correct?
Yeah, and who's taking the hit? It's going to be those producers.
The producers have to get it back somewhere, don't they?
Yeah, they got to increase those prices.
So actually,
or lay off people off.
Yeah, so the softening of demand has actually, contributed to the inflation. In the way that they have all these goods that nobody wants. And even though nominally speaking, you're going to be able to get a discount, in total, you got to pay for it somewhere.
Yeah, and that's going to be one of those big areas that we have to I say we have to keep an eye on this, keep an eye on this. There's a lot of things that we have to keep our eye on. That's going to be a big one for a lot of those producers because you talked about a little bit earlier, they have to increase those prices or they're going to have to potentially lay people off. And we're starting to see that, but I think we're going to see it a lot more later on in the year here and going into 2022. I think that's going to be the final phase here. Right now, a lot of people are going to be muted to those layoffs just because they can find something else or another part-time job. But it is starting to slowly but surely happen.
Yeah. So we just had a bill passed. Now, I know you've read it in its entirety, right, top to bottom.
Because top to bottom, all hundreds of pages.
Yeah. I'd like to get your thoughts on this, because this is supposed to, and this is marketed as a way to fight inflation. Is the CHIPS bill doing this in your mind?
I think a lot of it is going to be, of course, geared to climate change and combating that, and I don't think there's anything wrong with that. I just think that's what that overwhelming part of it is.
Yeah, right.
Another big portion of it, it seems like it's going to be geared to increasing taxes for corporations.
Right.
Which could, so for example, say I live in Chattanooga, Tennessee, and I'm working a job, and I'm making $50,000 a year, and all of a sudden, the payroll tax in Chattanooga increased 15%. I'm going to need to make more money because I'm getting eaten up by this new tax on my income, this income tax. So now I need to make more money. So I'm thinking from a producer side, from a corporation side, if they get hit with 15% on a tax or something like that, they're going to need to make more money. Or I'm going to have to move to a different state.
Right.
I'm going to move to maybe West Virginia. Maybe I'll move to Georgia. Maybe I'll move to North Carolina, where those taxes aren't as incredibly hard on my bottom line. And so I think this could be an area that could either erode some business investment domestically or increase inflationary pressures because now I have to make up some of those margins or some of that money that I was kind of losing out on from this 50% tax.
Yeah, so let me make sure I get this right. So if we have extra costs, the company has two choices. It can either reduce costs in another area, maybe shrinking in some sense, which could potentially keep everything on par in terms of inflation. Or they could pass along those increasing costs, which would actually add to inflation.
Yeah.
So if we're looking at this, we're either going to stay where we are or we're going to go up. So there's actually no downward pressure.
Yeah, and inflation. I think some of the things that could be deflationary in this bill, got to continue to kind of go through it and see what going to be some of the major levers are. I don't think are going to be really kind of pronounced until maybe mid or late 2023, potentially, further on down the line. But even though that might be a case, we're looking at those hard-hitting ones that could be building up more inflation. And I think that tax one could potentially be an interesting variable here.
Yeah. So, it's a very complex system we're in, to me.
Yeah.
and the things that we're using to treat the symptoms sometimes don't always hit the right spot and solve the underlying problem. Is kind of what we're getting at here. So, I encountered this article this week by Credit Suisse. So I want to give credit where credit's due. The writer, of course, uncovered or kind of just pulled back some curtains for me on some global economic things, geopolitically, I guess geoeconomically speaking, not just macro with the domestic U.S., but geoeconomically now. That we are now already engaged in a global economic situation. We talk about inflation domestically, and we seem to have a cursory understanding of that. Although what this article points out is something that is outside of our control at this point. And it's kind of what we do in Sonar. We say, hey, we know what we experience. We know all about our little world of transportation or trucking or brokerage, or maybe we're a company that works in beverages. We know beverages really well, but we don't know what's happening with everyone else.
Right.
And I think at this point, we need to kind of take another step back. And even if you're a company that is just a domestic company or domestic transportation provider, at this point, we have to take a step and look at the entire global community at this point. Do you think that's accurate?
Yeah, and I think because when you're looking at some of those impacts, they're going to come from a different part of maybe the world, the global industry or national industry, and that's going to have an impact on what we're seeing in the supply chain for sure.
Yeah, so of course, a big origination point of our supply chain is in Asia. But something else he called out, the Russian-Ukrainian situation with the cutoff of the Russian oil from Europe, we also are getting kind of a subsidy from cheap Russian oil via European countries taking advantage of it.
Right.
And it's not a lot different than what the United States economy and consumer and companies have been taking advantage of with China and their low cost of production for labor. So to me, we are actually, this is an argument that, even though we might have been saying, well, financially it makes sense to outsource production in China, we barely even see Russian oil. But we disagree fundamentally with the way that these two countries operate. I think as a people. And they're very autocratic. Obviously, that means that they get told what to do. And one of the reasons that they do have these cheap labor sources is because they have a different view of how freedom works. To some people, telling them what to do actually kind of relieves some pressure. And we have to acknowledge that. That may not be the way we think about it here in America, but in some regards, being told what to do, removing options may be okay to some people and may be better because they don't want to sit there and evaluate the 15,000 options they have, or they're happy with just having a limited amount. We don't agree with it, but some people might. But this is what's enabling the low cost of production in a lot of senses, is because they do have this kind of autocratic system where they are told, you've got to go be an engineer today. And that's how Apple has actually grown over the course of the years, is because they outsource. You cannot find, you couldn't make a phone as cheaply as Apple can in America. Because we have minimum wages. We have people get a choice of whether or not they want to be an engineer or not. People go into things that they have interests in. That's what we value as a society. But we also don't value it as a society because we've been, as a corporate, culture, outsourcing all the production across the ocean to lower costs. So we're happy to take the benefit, but we're not happy when that side of the world where our production is starts kind of flexing their muscle on us, and kind of impacting our day to day, right?
Yeah, 100%. And I think when we're looking at, for example, China, there's a lot of things that they could do to really disrupt us domestically. They, I think, could probably dump a lot of, U.S. Treasury bills. They could really mess with all of the supply chain there to really kind of mess with our supply chain here when it comes to manufacturing, things like that. Would it harm them in the near term? For sure, because they are going to not be able to produce and sell a lot of their goods. But really, it could really shift how we operate domestically. And that domestic operation could really be something that we would feel for quite some time, because we don't have that same infrastructure domestically as they do in China to manufacture a lot of these goods at a mass scale. We don't have a lot of the workforce that they have in China to also operate some of the machineries that we would need to be operated in order to produce all the stuff here domestically, or maybe nearshoring, maybe in Mexico or some parts of Canada, but likely Mexico.
Yeah. I mean, and you can't do that overnight, obviously. So in the near term, to me, so considering that China still has a zero COVID policy, even though demand has eroded, from the supply side situation, those two areas, Russian oil and China production, their costs are now going up. Our relationship with those two countries has deteriorated. That's going to make things worse. Tariffs are not going away. It's just simply going to be an escalation. So the supply side of the equation, there's another level of inflationary pressure. Am I right?
Yeah, and once you kind of point out as well that there might be some holdups and some of those more timely or seasonal items that a lot of producers are going to look to try to get out, that could really start to, again, build up some inflationary pressures. And not to say that inflation won't start moderating or things like that, but it's not coming back down to 2% for some time here.
Yeah, 2% targets. And of course, everywhere in the world has seen some level of inflationary pressure.
Yeah.
It's not just the United States. China, I think they reported a 2% number, or it was over 2.5%. Just
China.
recently. I mean, they reported it. They take it for what it is. But their costs are going up too, which means our costs go up.
Yeah.
And they are also suffering from a bit of an economic downturn, as reported by them, which means
it might be a lot worse than what it is.
It may be terrible over there right now, which means they're going to start doing things such as run military exercises in Taiwan or around Taiwan to kind of start saying they're flexing their muscle. Now, this is a monster we've created, have we not?
Yeah, 100%. And that's going to be one of those areas that I was thinking about as well, is operations in Taiwan, because we definitely made a visit there not too long ago, and that kind of ruffled some feathers at the time. And so I think we're looking at that. That could throw a huge wrench into what we're seeing domestically here with the supply chain, and really with production of goods, because one of the areas that we have seen, of course, that tariff that's still in place that I think happened throughout the Trump era, still in place with the Biden era now.
And that's also a thing that we could do to reduce inflation, correct?
I think so, but I think it could also be something that the U.S. doesn't want to do, because potentially that would take fewer dollars out of from the U.S.
Okay.
So I think that could be an area for sure, but I don't know if the U.S. would be wanting to do that, because I think they would try to get that money back somewhere else.
Because that's what the CHIPS bill also, we're trying to invest in domestic production.
Right.
But okay, so riddle me this. We've got this unstable production facility region in China. We disagree with a lot of the stuff they do, morally and physically. So to me, companies, and we have two choices. We can kind of hope that things clear up over there and everything goes back to the way that it was pre-COVID, which I think is a fool's errand. Or we could start to diversify our supply chains, which I think a lot of people are doing. Do you think that will actually materialize or manifest itself in the near term and actually have some sort of deflationary pressure? Or do you think that actually, in my mind, actually still increases it's inflationary?
I think it's inflationary. And I think from a lot of these inflationary pressures that we've seen, especially upstream with the producers, one of the things you mentioned also a little bit earlier on in the show was minimum wages. I think that's going to be something to watch. That's how it's going to shift how we do business and produce goods upstream. And I think it's going to come in the form of automation. And so I think one of the areas that the U.S. can really kind of lean heavily into is going to be that automation play. And so I think we're going to see a lot more investment into automation. And so I think that could potentially make some individuals a lot more productive, of course, but eliminate a lot of individuals from the workforce altogether, because now it's going to be a lot more price efficient to automate some areas, whether it be in a warehouse, whether it be in some services aspect. Go to McDonald's, you can really automate a lot of the stuff. Now you don't have to talk to anyone. You can just kind of pinpoint everything that you want on a big screen, and just next thing you know, it's out and open. I think they're also automating, not that I'm obsessed with McDonald's, but cooking fries and things like that. So there could be a point in time where we're starting to see a lot of these entry-level jobs being automated completely. And that's going to be because some of the minimum wages are just going to be too expensive not to automate. And I think that's going to enter the field of manufacturing. I think that's going to enter the field of warehousing for sure. And so that's going to be an area where I think that we're going to shift heavily into. And because that's going to be very capital intensive, there might be some inflationary pressures to really kind of build that out as well. We see a lot of large corporations like Amazon really leveling, or I would say it's Amazon to some extent, but a lot of large corporations really saying, hey, we want to increase minimum wages. We're going to increase this minimum wage. We're going to increase this minimum wage. They can sometimes take those hits that smaller companies can't. So they can gather market share. And then as they do that, they can shift into automation. And now it's almost like a barrier of entry for a lot of other companies to really enter the market.
Yeah, I mean, so the big takeaway from today's show is get used to inflation being above 2 to 3% for a while. It looks like, even though we did have a temporary kind of drawback, don't take that as a long-term trend, because what do you need for a long-term trend, Anthony?
You need long-term solutions here.
But you need more than 2 points. You need more than 1 point. And we only have one. And so companies are going to have to get ready for continued inflation, because even if it does continue on this trend, say, 8.5% is still extremely high. And say we go down to 8.3 next month,
Yeah.
it's still high.
It's still high. And the other big thing that also kind of got updated earlier on this week is the productivity level, which dropped for the second quarter.
I was going to ask you about that. I'm glad you brought that up. I want to spend the last few minutes that we have on this one, because this one baffles me.
Yeah.
Now, I've read some of the stuff that says we just expect the numbers to adjust in the future because it doesn't make any sense to us as economists. What is your take? But explain what it is first.
So essentially, it's how productive a unit of labor is in their job. So what we're seeing right now is that the output is not so at the same level of money going into the labor being put into place. And so
you're putting a lot in, but not getting as much out.
Yeah, especially when it comes to pay and wages. So
it's like you paid $1.25 for a Coke to come out of the Coke machine, and it was a 20-ouncer.
Yeah.
Now you're putting $1.25 in, and you're getting 18 ounces.
Exactly, and that's something that felt shrinkflation, paying more for fewer goods or fewer goods. And so one of the things that we're seeing here with the productivity level is going to be an inflationary builder as well, because we are now seeing that we're pouring more money in and we're getting less in return.
Supply side. No, so they're not producing as much. So you gotta spend more money to get a lower amount.
Exactly, and this is going to be an issue because it's all going to be something that kind of erodes at companies, in addition to wages, in addition to being able to really kind of curtail some of those inflationary hits because they haven't passed all of it down to the final buyer or the consumer just yet. They are passing it all down, but there's going to be another area that they get hit by. And so with their margins, they're going to have to increase prices once again to keep up with this lower productivity cost.
So why are people producing less? Why are we producing less? Do we know why?
So I think there's going to be a few things here. I think one of them is that some folks aren't going to be as productive working remotely. I think that's one. I think some people are, and it's great. But I don't think a lot of companies have found that the solid balance right now. I think that's going to be one for sure. But what we're seeing right now
But why would it manifest now? We've been working remote for 2 years, and then all of a sudden, we can't?
So it's happened, I think, from the beginning of 2022. So it's been happening for, I think, over 6 months now. Okay. But I think that's going to be an area that we have to watch. That could be.
Do you think the labor market has actually contributed to that?
I think the labor market has, but I think there's been a shift in qualified labor for those qualified roles. And so when we look at the composition again, we're seeing fewer baby boomers, those experts that have been in the workforce for quite some time. We're seeing fewer women in the workforce as well. So there might be a lot of women that were highly trained, highly professional in certain
I've had this discussion numerous times. The amount of women that have come out of the workforce is actually alarming. Because of the eradication of childcare and things like that. The women are the glue that holds this shit together.
As we see the productivity level dropping.
They do a lot for keeping the organization of these companies together, and without them, obviously, there's a structure that falls apart.
Exactly, and I think that comes back to that labor pool composition. Fewer women in the workforce, fewer baby boomers in the workforce. I think that's also going to start to erode some of our productivity level as we continue to move throughout 2022.
Anthony, I mean... So we got through just about everything I wanted to get through today. But I mean, I think the economic outlook is still pretty cloudy, right? I mean, when you're talking about going into the next few months, this whole idea of are we in a recession or not, I think is pointless.
And I don't really. I'm only obsessed now because everyone else was obsessed with it. I don't really watch the GDP that closely. The
GDP is a relatively useless figure
for the most part. But the thing is, so GDP could go up in the third quarter and people would say, hey, Anthony, what are your thoughts on that recession? I'm like, it still happened. It's still technically a recession. So just because, say, GDP does go up in the third and fourth quarter somehow.
And was the GDP number adjusted for inflation?
So the real GDP is, and the nominal GDP isn't. So when we're looking at that, even if it went up, I would still say, the first half of 2022 was a recession, and that's fine.
And then you have all these commodities sitting underneath it that are inflating at different levels. You know, gas inflated at like 40%. For a period of time until these last couple of months. And, food prices, they've inflated at a different rate. there's only a few of them, like electronics and things like that, that haven't inflated at the same rates. And that's something you have to take into account, right?
Definitely something you have to take into account. And also big ticket items, houses, cars. You're starting to see cars starting to come down. Used car prices, like I said earlier,
things are
rates starting to pick up again.
Things are getting more expensive. They're going to continue to get more expensive. The economic engine is going to slow down. We've still got a long tail to go here. The jobs market, the place to watch. I don't have a lot of confidence in that interest rate going up and having a near-term impact, do you?
No, not on inflationary pressures. It's just going to be something that they can try to build up as fast as they can, as soon as they can, so they can potentially use it on the latter half of this whole thing.
Man, a lot of stuff today.
A lot of stuff. And remember, beginning of recessions, the unemployment rate is usually pretty high, pretty low. At the end of the recession, very low. Then it starts picking up towards the end of the recession. So just because it's low now doesn't mean it's going to be low for quite some time.
So much. Join us, same bat time, bat channel next week.